Hi, good afternoon, everyone. Since the introductions have been done, I'm going to jump right into the questions. So Yamki and Alejandro, this is for both of you. How do you describe disclosure in the context of Web3 companies, and how do you feel that regulatory framework should be driven to enable this sort of disclosure, which will lead to retail and investor protections?
I guess I'll start with that one. I don't think the definition of disclosure should necessarily change just because we're talking about Web3 companies. Disclosure is really having to share everything that's material for an investor to make a sound decision about buying a financial product in this case. It's something that we obviously see in the securities law space. Now, the problem is that obviously the old securities laws and the regimes that exist right now in terms of disclosure requirements, they're tailored to traditional companies, and there's definitely things that are different in the crypto space that I think regulators just need to start adjusting for. I think the best way to probably approach it, I would say, is to just either study the space quite well and try to issue regulations and guidance that is actually quite tailored to the space, or otherwise allow for more self-regulatory organizations and efforts to kind of play that role and bring a more sound framework for the space. There are some existing regulations out there that have already taken a particular approach. I really like MiCA in the EU in particular, and I actually think that the rest of the world and regulators should be looking toward MiCA to learn a little bit about what they did, because I think it's a very good starting point for tailoring regulation to the space.
Well, first, thank you for FACTBLOCK for organizing this, and the team at Hash for sponsoring, and Medha for moderating. Before we jump in, maybe a little bit of background. So I'm part of Circle. We are a Web3 infrastructure company, and we're known for a couple of things, Web3 services, but probably more well known on the stablecoin side. We're the issuer of USDC. But what does that mean in terms of the disclosure part? There are many stablecoins out there, but not all stablecoins are created equal. We have taken a particular approach in how we structure our stablecoins, in how we think of our asset management, and how we disclose how we manage that asset. So as an example, when we take fiat, majority of those go into a reserve fund that is managed by BlackRock. It's an SEC-registered fund. It's got a ticker. You can see what's in it down to the individual serial number of the treasuries. You can see that on a live basis. And the remaining are in cash deposits at a bank. Every month, we do an attestation that's done by our auditor, Deloitte, to attest that the number of tokens out there matches the reserves that are held for the customers in fiat. And then, of course, once a year, we go through an audit. So that's sort of one framework in terms of how we're thinking of disclosure. And a lot of the regulators that we're speaking with all around the world are taking that and embedding that into how, at least in the case of stablecoin, should be structured. That there is a clear outline in terms of what you're holding. They're generally high-quality liquid assets, so you're holding things like treasury bills and not some undisclosed loans or other type of assets. And then there is an attestation, at least on a monthly level, to show by a third-party auditor what that looks like and does it line up. And I think part of what we're struggling with as an industry is the fact that this is relatively new. Right? We're a relatively new industry, and many haven't gone through that process of thinking about what are the responsibilities that we have to, as whether it's issuers or exchanges, to our customers and to the end user. And this is a space I think we're going to see a lot of developments in.
So, I think you've covered part of the answer here, but both of you have played very different roles in the TradeFi industry before moving to the Web3. So how has your individual experiences in the traditional finance sector shaped your understanding of how regulation should be drafted for the Web3 world? And I'd add on to that there's been the initial theory espoused for Web3 companies has often been of a more trustless, permissionless system. So how do you integrate regulatory framework with that sort of trustless system that blockchain seeks to achieve?
Yeah. Well, I think, I mean, from what one learns being in TradFi and being obviously a lawyer that focuses on this space, that was my job. I mean, I think there's a lot to learn from what has been done, and I think that's what the Web3 world sometimes just doesn't realize. I mean, some of the regimes that have been built over years and years of experience are actually highly relevant to Web3. So it's natural for regulators to be looking at some of those regimes and seeing how they apply them to the current regimes. There are very important lessons as well historically to be learned as to what the effect of regulation was in situations that were actually very similar to the ones that we have right now in crypto. I mean, if you look at, for example, the US prior to the Great Depression, prior to that 1929 crash, I mean, what was going on in the stock market was actually remarkably similar to what we have in crypto today. You had like rampant speculation. You had these stock pools and investment pools that were like these whales essentially manipulating the market, doing pumps and dumps. You had a bunch of like securities that were worthless being issued without any sort of like real companies behind them, real assets behind them, doing effectively what we now consider in crypto a rug pull. And you had also marketing tactics that increased FOMO in people to go into these securities and then essentially like abuse the public, right? So I think people don't understand in crypto that we've already seen this and we've gone through this and we've issued regulations that actually brought the confidence back into the market and allowed the economy in the US, and this is probably a similar story in many other countries, to then just get that confidence back into the stock market and let it grow. So there's a lot there that I think we have to learn, and there's a lot of things that will actually also work for this space. But I think to your point of having this, highly decentralized space that is supposed to be trustless, I mean, I think we also have to be realistic. I don't think the governments are going to allow this to be that utopia that like the crypto world really envisions it to be. So we have to work within the bounds of what's realistic and what regulators are going to be worrying about. So you have to just find a happy medium, and that's why I do think that tailoring to a certain degree to allow some of these things to work, to allow for decentralization and for DAOs to exist the way that they do, like there's definitely things that will need to change in disclosure, but regulation is going to happen, and it's actually not a bad thing for this space. I think right now we need regulatory certainty, and we need certain structures to allow the industry to really mature.
Well, I think building on that, the first rule of regulation is wear a suit. So maybe I've done that part of the structure. But in all honesty, touching on some of the points you mentioned, what we are seeing in the problems of the digital asset and the crypto space are not new. They have been around since the 1920s, 1930s, when securities were originally created. The approach for most regulators tend to be same risk, same policy, same policy outcome. And that's a very sensible mode. I think on the one hand, you have the traditional finance folks, as this is the same business, we apply the exact same rules and we'll apply them as is. On the other side are probably more crypto-focused firms, digital asset firms, as we need totally new rules. And my take is that the answer is probably somewhere in the middle. That to some extent, you will probably take the pieces within traditional finance that are very, very relevant. Things like market conduct, of front-running your customer, unfair trade practices. These are things that we all agree as what's needed for a fair market and an appropriate market for all of us as an ecosystem, as issuers, as protocol owners, as users and traders, and as businesses to be able to succeed. On the other hand, we do all recognize that the technology is a little different. So some of the things in the traditional world doesn't apply as well. Things like a broker-dealer, right? If you're on-chain, who's the broker? Who's the dealer? How does that work? Are you an exchange? Well, it depends on what exact activity are you doing. Are you just matching orders, or are you running a central order book? These are things that we have to sort out, but I don't think it's one or the other. And what we're seeing is that depending on the jurisdictions, they're coming out with slightly different frameworks of what that looks like. And we can talk a little bit more like what's going on in Singapore, in Hong Kong, and in Korea, and in the US and in Europe, and how they're thinking through these pieces of where their baseline is and what framework they're thinking through to create that middle ground in that spectrum of traditional finance and virtual asset finance.
Sure. Yamki, I have another question for you on this. The digital asset industry is, even over the years, is still considered in a very fairly nascent stage. The kind of ups and downs that we are seeing is not uncommon to any new technology or any new business that comes about. So from your perspective, what are some of the challenges that a company can face from a disclosure perspective in this early stages of development?
Well, first of all, it's trying to figure out what your business model is. I think like any sort of startup ecosystem, many firms probably start with an idea, and then you have to iterate and iterate and iterate. And I think being very clear and upfront, first with your investors, whether that is through a token offering or through raising funds with the VC, you have to be very clear, what is your business model? Where are you trying to go? What are you trying to go? And then as that evolves, make sure you update that framework and be very clear with your investors and then also with the public. Once you start launching in some way, even in beta form, you have users. And that means you have responsibilities, right? And again, in this ecosystem, there are lots of bad actors that you've talked about. There are rug pulls. And I think the difference between the ones that are going to last, a short-term gain, or the ones that are going to last for a while, or the ones that have in place and have a maturity to think about what role do they play in the ecosystem and how they support the broader ecosystem and investors.
Sure. Alejandro, I think let's talk a little bit about Mooncheck. You are developing an AI-powered disclosure system. So as a former lawyer in the TradeFi industry, what are some of the common legal challenges that potentially Web3 founders can face? And what would your advice be in terms of issuers or founders with limited capital who kind of overlook the importance that legal advice and disclosures can have in the initial stages of their business? Yeah.
I mean, I have to qualify this, and I mentioned this earlier. This is not legal advice. I have to say that, but okay. So look, I'm a founder, and I've been a founder for some time, and I understand. I understand where like young founders come from and how it's actually difficult and it's expensive, and so you don't. It's sort of like the last thing that comes to your mind, and some of them actually don't even know what they don't know, and I think that's part of the problem. And so a certain degree of finding that certain degree of guidance is actually really difficult. But if I were to actually just recommend to founders what to kind of focus on at an early stage, is essentially what Yamki said. You have to be aware that you have an impact on people, and that they deserve to know what it is that you're doing. So I look at this from a pure place of transparency sometimes, where if you actually are transparent as a project or a founder, you are already a good way there into satisfying a lot of the concerns that regulators have. Then the rest is like topping that up with like the paperwork and little things that will happen, but you will develop a lot of goodwill with regulators if you actually are just sharing information and you're very transparent about what you do. This means, sharing everything that you think could affect, like, for example, the price of your token, not being deceiving with your marketing, not omitting information that you think is extremely important for people to make that decision. Just be open about what you do. And I think that's sort of like the best kind of like basic advice that I can give to early stage founders. I think the other thing is trying to find, obviously, tools and help somehow. I mean, this is something that can get pretty difficult to navigate. I think legal issues are complicated, and that's why people tend to avoid them. I would say try to find tools. I mean, I'm not just shilling here my own project, but try to find different tools that will help you. And then also try to find, as you move forward, a lawyer, I would say, earlier than you thought you needed a lawyer. And I actually, very much not a lawyer, but a lawyer at the same time. But that's actually very sound advice. And I think if you're getting to like a certain growth level, a certain investment level, you actually need to do that. And it's going to save you a lot of money and pain down the line. So I would say that you can't just shirk away from that type of responsibility that you're going to have.
I want to add to that. I think, building a company is really, really special. And you're doing so many things at once. And part of being the head of the company, the founders of the company, is to figure out what you don't know, right? You have a vision of what you want to build. It's usually a really good one. And it's human nature to find people to agree with you and to keep going forward. And part of being at least in the Silicon Valley ecosystem where I started my career, is to find mentors, find VCs, find investors that add that strategic value to help at least give you a sense of the things that are hanging out there. You don't necessarily have to focus all your attention into problems, but at least know what those could be and how to build your company in such a way where, okay, at a certain point, you're gonna hit a particular snag, or you might have more at risk than you thought. And that is really protecting your investment, protecting your time, protecting your employees, protecting your shareholder. So think about it in that way. And again, find those right VCs, the right partners, the right advisors and mentors, because that's going to make you stronger and able to go faster in the long run.
Right, thank you. Alejandro, I would like to discuss a little more about the Mooncheck, because you're building an AI-powered disclosure platform. How do you think this is going to help early-stage founders in achieving a sort of disclosure level where regulations don't yet exist?
Yeah, and I actually, when you mentioned, Medha, that you were asking that question, I actually thought that it's kind of better to go and talk first about the benefit of disclosure even for founders, because I think, a lot of, simply because it has a connection to regulation, I think just it scares people a little bit. But the reality is that founders that are smart, just like you mentioned, should also be looking to share more information, because there's actually benefits that come from that are very well kind of documented through time. I think, for example, closing that informational asymmetry that exists between your company and the public just reduces the gaps where people can actually speculate and essentially increase the volatility of your token, for example. It also allows you to attract a different type of different types of investment. There's a lot of investors out there today that are getting a lot more strict about how you are and how transparent you are, and they have certain things that you have to meet before they actually invest. That's also what we're trying to do in Mooncheck somehow, because we're trying to make the crypto space also more palatable to the traditional investor world, but they obviously have requirements that are a lot higher than a lot of the early stage investors that are now in the crypto space. So that it will allow you to attract new type of capital as well that you're not kind of used to having. At the same time, I think it's just good practice to be transparent, because I think your overall the value of your company is going to increase, even though you think that it might you might have to make a big effort to actually get there. Overall, it's good. Like I mentioned, it reduces also you don't have that target on your back as well from regulators, because you're trying to do the right thing, and that's a lot of what they care about. Regulators are willing to get into a conversation with you before taking action if you're taking steps that are the right steps to go forward. So I think it's really important to do it first of all. Now, Mooncheck, the problem that we had is how do we make it easy for these early stage projects as well to be able to write that level of disclosure, and what is that level of disclosure, as you sort of asked. So first, I think we took an approach that was very kind of all-encompassing when it came to disclosure. As a securities lawyer, I had the privilege to work in many cross-border type of transactions, IPOs in different countries. And one thing that I learned from that experience was that there's still like the overlap in terms of what the regulators globally want you to do in terms of disclosure, it's very, very significant. And then the rest, like there's small difference that you kind of just can patch up. So, but what we decided is like, let's go the conservative way, try to include as much as possible into the standard, because ultimately it's up to you what you want to share or not, precisely because there's no regulation. But what we were trying to do is sort of like take something that is normally very expensive and time consuming to do, and it requires the involvement of lawyers, to try to guide you with AI to become like transparent and have really full-blown disclosures in all areas that not only we see regulators paying attention to, but also in discussions with industry experts, we've decided that those are areas that should be included in disclosure. And in fact, regulators should be looking into solutions like these to kind of guide themselves as to perhaps what should be part of their disclosure standard. So, but the AI is incredibly helpful because it essentially replaces the initial job of a lawyer of asking you the right questions, teasing out information from you, and then delivering disclosure in a way that is written very similar to what you would like find in an actual traditional, for example, prospectus disclosure. So it's very helpful. It's very helpful for founders that, for example, they'll think, well, I can't speak English well, I can't write disclosure. Well, now you don't have an excuse, because like the AI will translate even complex concepts in blockchain into plain English disclosure that allows you to become transparent and share all that stuff with the public, right?
And I think, do you believe that this would also help companies that operate in multiple jurisdictions, as very often Web3 companies do, to approach disclosures and regulatory frameworks that can be fairly fragmented from one jurisdiction to another as it stands today?
Yeah, I mean, I do think so. I think all of the regulations that are coming out right now globally all have disclosure as one of the main tenets of the regulation. So this is never going to hurt you in that sense. You're always going to have a leg up, no matter where you're operating. But like, as you also mentioned, I mean, we're in a world and in a crypto world where the borders all of a sudden are getting raised, and that's problematic from a compliance perspective. Now, you will still need eventually to mature to the level, especially as the regulations do come out in different countries, to pay attention to exactly what's happening in a particular country that you're operating in or that you're being traded in, right? You're listed in a particular exchange. You're going to have to pay attention to those markets to see how you patch up that gap that perhaps is left from you being transparent already to the quirks and nuances of what that particular regulator wanted you to do. Now, like, there's ways of doing that too, and I mean, in our platform, we're the plan is to build that. We're doing it first for MiCA, but after other regulations are coming out that are more certain, we're also going to allow you to kind of go through that same path to be able to become compliant in different countries. Now, it's work, right? You still have to do the work, but you can't avoid it at this point because regulation is coming and there's no way to avoid that.
Yamki, on stablecoins, do you see a difference in approach towards adoption of stablecoins by regulators and retail customers when you compare Asia and the West?
Yeah, it's a great question. The use of stablecoin actually has a greater product market fit in Asia than it is probably in the US and potentially even in Europe. On the kind of crypto side, mostly stablecoins are used as a store of value in between trading different positions. But as we move from the speculative phase of crypto to a utility phase, what I expect to see is some of the more real use cases for that to take hold. And some of those were talked about in the previous panel around cross-border. So I'll give you 3 examples. One is cross-border trade. And there, most of the economies, all the economies in Asia, has a higher trade to GDP ratio than the equivalent in the US, which is only 10%, pretty closed economy, or in Europe when you remove intra-European trade because they're on the same currency union, right? If you're selling something from France to Germany, it's straightforward. It's euro. If you're selling from New York to Florida, same currency, US dollar. That's not true in Asia. The businesses that are built here, for example, you may be running a store online in Korea, your customer is in Japan and you're taking yen, and you're paying your vendors in Vietnamese dong or in Thai baht. All of this means that the business is carrying that FX cost and that settlement time in between getting the payment and paying their vendors. Related to that is trade financing. The ADB, the Asian Development Bank, has estimated that around $510 billion of trade did not happen because the firms are unable to secure financing in the form of insurance, letters of credit, or loans. These are goods that never got made, services that never got provided because the companies couldn't carry the cost, right? For those of you who run a regular business, you know that when you're selling goods, you don't get paid until your good arrives at the port on the other side of the world. That means you're providing a credit in that period of time, and you're fronting that production cost. All of that, I think there's an opportunity for stablecoins and for DeFi to actually support the lending of. And then thirdly is remittances. And there, the World Bank has estimated that for an average $200 remittance, the cost is around 5.9%. That's a really expensive cost to move money between you and your families. And this tend to hit usually the most vulnerable and the working class of each of our societies. So how do we solve some of these problems? I think specifically in Asia, through the use of stablecoin is really unique, and I expect to see greater adoption, especially in this cross-border use cases.
That's very interesting. And I think the difference in currencies between the countries is what is going to drive that adoption even more.
Yeah.
So in terms of what Circle plans to do for the future, what is the kind of role that you envision Circle playing in the broader financial ecosystem? Because we are seeing a lot of institutional interest also in cryptocurrencies and in stablecoins. So where does Circle fit into that entire developing system that we are seeing now?
So as I mentioned at the very beginning, Circle is really a Web3 infrastructure company. And it's not only financial services focused. I think primarily there's USDC. We also have a Euro coin. That's the stablecoin part of the business. That's the movement of money on the internet, digital dollars online. We now have this other part of the business, which are Web3 services. And these are some of the things that, again, the previous panel had talked about. There are companies in the Web2 space that want to move into Web3, but they don't know how. It's hard to program on blockchain. It's hard to make the disclosures to the end users. It's really hard to figure out the security and privacy. So what we're doing there is we're launching a series of Web3 as a service, so similar to AWS or GCP, Google Cloud Platform, where a traditional business can, say, develop a programmable wallet as part of their offering, white label it, put their name on it. And there, it's not just financial services. This could be a digital wallet company. This could also be a regular retailer that wants to do, for example, loyalty programs, right? How do you handle loyalty and collection of stamps, right, as you go from store to store? How do you do cross-retail partnerships? Gaming is another. All of the Web3 side, the entry point is the wallet, because that's what you need to be able to hold certain tokens. Then there's the next part, smart contracts. How do you build in ways to make these wallets interoperable and able to do things automatically in between different machines and different platforms? And then third, we have something that's coming out called PBMs, purpose-bound money. It's how do you tie logic around the movement of value? Things like e-commerce, where the money moves with the goods, but the seller doesn't get a chance to unwrap that until the goods have arrived with the buyer and it's checked against, and then you unwrap that and the value is delivered. So things like that I think will be really interesting to see as we move into the utility phase of crypto.
So our time's up, but I'm going to ask one last question to both of you. Where do you see the Web3 community growing forward? And could you tell us some of the essential things that you think are going to be necessary for the mass adoption of a decentralized internet?
Sure, I'll take this one first. I think, because that kind of dovetails nicely with what Yamki was saying about Circle. I actually think that one of them is infrastructure. I think, finally we're seeing that the crypto space has realized that they need to take a step back and sort of build the basic blocks of the infrastructure side for things to actually be better. Because that also, I think, leads to some of the lack of security as well on the technology side that we've seen that has become a pretty serious problem in the space. So that's one of them. I actually think that the other one is obviously transparency. I think the space just needs to begin to embrace transparency, and that should be coupled really with some degree of regulatory certainty. So that is two. And the third one, which maybe some people will think that it's small, I don't particularly think it is. I think it's working on the user experience. I mean, the UX in Web3 is just simply awful. And until like the Web3 space realizes that there's been, many years of studies in UX in Web2 and look at how they actually do that, they're not going to really have mass adoption proper.
Yeah, there's a really good chart from A16Z on the state of crypto. If you haven't seen it, you should go find it. And it shows the number of internet users from 1990 through 2019, so roughly 20 years. And the same around number of Ethereum wallets on monthly transacting and annual transacting. And there's a correlation in terms of the trend. We're in the early days of the internet, right? We're in the new version of the internet, and we're in the very, very early days. To get to mass adoption, 3 things need to be true. First is we need more developers, people probably sitting in a room that are builders that know how to build on Web3. Second, related to the question on the point you made on UX, these are web services that makes it easier for people to incorporate Web3 technology into existing stack and take the best of Web 2, which is the UX experience, and bring that to the Web3 world. And then third, coming back to what we talked about, regulatory clarity. When you have regulatory clarity, not only are companies here could exist, but also for the large institutions, they are able to then come on board because they know what they're holding. They don't run the risk afoul of their regulators and their shareholders, so that clarity provides that platform for them.
And we didn't coordinate on this, by the way.
Thank you, Yamki. Thank you, Alejandro. That was a very informative discussion. I'm sure our audience greatly benefited from it.
Great,
thank you, Medha. Thank you for having us.
Thank you.
Thank you, ladies and gentlemen. Once again, give a big round of applause for these 2 great speakers and also our